All right, so today we're going to dive into a really fascinating story playing out in the tech world. It's got a huge market leader, ServiceNow, a pretty gut-wrenching stock drop, and a very specific and I think pretty clever financial strategy that some are looking at in response. Let's get right into it.
Okay, first things first, you just have to look at the sheer scale of this drop. I mean, wow. Over the last year, ServiceNow was flying high, trading at over $200 a share. Fast forward to now, and it's bumping along its lowest point. That's a decline of almost 60%, a massive, massive shift.
And this isn't just about ServiceNow. Market observers are using some really strong language here, calling what's happening to software stocks this quarter a full-fledged breakdown. When you hear terms like that, it tells you there are much bigger currents pulling things under than just one company's story.
And this all boils down to the huge question, right? When you see a popular, well-respected company fall off a cliff like this, what is the market telling you? Is it a giant flashing warning sign to run for the hills? Or is it a sign that a fantastic company is suddenly on sale?
So, let's take a closer look at this tech darling's dive. A drop this big never happens in a vacuum, so we're going to unpack what's really going on here. And just to be super clear here, ServiceNow, you'll see it under the ticker symbol NOW, is a major, major player in cloud computing. We are not talking about some small-time startup that missed a few targets. This is an established industry leader hitting its lowest price in a full year. Which, of course, begs the question, why? Why is a market leader like this getting hit so hard right now? Let's unpack the reasons.
Well, from what analysts are saying, it really comes down to two big pressures. On one hand, you've got the US government, which is a massive customer, slowing down its spending. That hurts. And on the other hand, you have Wall Street getting a little impatient with AI. Everyone's excited about their Now Assist AI platform, but investors are starting to wonder, okay, when does this actually turn into real money?
Okay, so with all that in mind, here's where the story takes a turn. Is this stock just a trap waiting to spring on hopeful investors? Or has this massive price drop created a genuine bargain? Let's see what the folks who crunch the numbers for a living have to say. And what's so interesting is that even with all this negative chatter and the stock price getting crushed, you have respected sources like Morningstar basically saying, hold on a minute. They're looking at the fundamental business and concluding that the stock is statistically undervalued. In other words, the fear in the market might have pushed the price well below what the company is actually worth. And this is where things get really clever. If you're an investor who agrees that the stock is undervalued, there's a specific financial strategy you can use to play this exact situation. It's called selling a cash-secured put. Okay, so what on earth is a cash-secured put? Let's break it down. It's an option strategy, but don't let that scare you. In simple terms, you're making an agreement to buy a stock at a specific price at some point in the future. And just for making that promise, you get paid cash right now, today. That cash payment is called a premium. The best way to wrap your head around this is with an analogy. Imagine there's a house you really like, but you think it's a bit overpriced. So you make a lowball offer. Now, what if the seller paid you a fee just for making that offer, whether they accept it or not? That's what this is. You're getting paid to name your price on a stock you'd actually be happy to own. So let's stop talking theory and look at the actual play on the table for ServiceNow. The idea is to sell a put option with a strike price of $80. That means you're agreeing to potentially buy the stock at $80. And this agreement lasts until the expiration date of May 15th. So you're basically targeting an entry point that's even lower than the stock's current 52-week low. All right, so you make the trade. What happens next? Well, it's not just a simple bet. There are two very clear, very distinct outcomes, and it's really important to understand both of them. The whole process is actually pretty simple. Step one, you sell that put option, and bam, you immediately collect your cash premium. That money is yours to keep, no matter what. From there, it's a waiting game until May 15th, and that's when you hit a fork in the road. Okay, let's talk scenario A. This is the easy one. If ServiceNow stock price is anywhere above your $80 strike price when that May 15th date hits, then nothing happens. The option just expires worthless, and you walk away, keeping that nice cash premium you collected up front. It's basically pure income. But what if the stock does drop? That brings us to scenario B. If the stock price is below $80 on expiration day, you have to make good on your promise. You are now obligated to buy the shares at that price you agreed to, $80 per share. But remember, The whole idea is you were perfectly happy to own the stock at this lowball price to begin with. And this right here is the really cool part about scenario B for anyone who actually likes the company long term. Because you already collected that cash premium up front, your real cost isn't $80. When you subtract the premium you were paid, your effective entry price actually drops into the mid-70s, a level the stock hasn't seen in years. You essentially got a discount on your already discounted price. So there you have it. That's the whole play. It has two possible outcomes. Either you make a little bit of income, or you get to buy a stock you already wanted at a fantastic price. It really brings us right back to our big question. Is this just a risky gamble in a choppy market? Or is it a truly clever way to get into a beaten-down leader? Well, that's what the market is about to decide.